What exactly is liquidity in trading, and why should you care? Today we're breaking down one of the most vital concepts in the market. Liquidity is the collection of pending orders that large participants like banks and hedge funds need to buy or sell significant volume. In practical terms, liquidity is usually found where many retail traders place their stop losses, buy stops, or sell stops. Think of liquidity as fuel for price movement. Before the market makes a strong move, it often seeks out this fuel first. Understanding liquidity helps you avoid getting stopped out unnecessarily. Many traders place stops in very obvious, predictable locations. These obvious spots include areas above resistance, below support, or at recent swing highs and lows. Price often sweeps these areas to trigger those orders before moving in the actual intended direction. By waiting for a liquidity sweep, you can improve your entry timing, achieve better risk-to-reward ratios, and use smaller stop losses. Large players cannot enter huge positions without enough counterparties. They drive price into liquidity to fill their orders. There are two main types. Buy-side liquidity, or BSL, is found above highs like previous swing highs or resistance levels. Price moves above these highs, triggers the buy stops of short sellers and breakout traders, then reverses. Sell-side liquidity, or SSL, is found below lows, such as previous swing lows, equal lows, or support levels. Price dips below the low to grab that liquidity, triggers stop losses, and then rallies upward. How do we identify it? Look for equal highs. When two or more highs form at the same level, it creates a massive pool of liquidity. Similarly, equal lows act as a magnet for price. Traders buy from these lows and place stops just underneath. The market also frequently targets the previous day high and low, as well as weekly or monthly extremes. The more obvious a swing point is, the more liquidity accumulates there. Always ask, where would a retail trader put their stop? A liquidity sweep occurs when price briefly moves beyond a key level to trigger orders before a sharp reversal. In a bullish sweep, price drops below a low, institutions buy the triggered sell orders, and then price rallies. In a bearish sweep, price breaks above a high, buy stops are triggered, institutions sell, and price falls. The most powerful setups combine liquidity with market structure. First, identify the liquidity and wait for the sweep. Then, watch for a change of character or a market structure shift. This confirms that the big players have entered. Finally, enter on the pullback. This is much more reliable than trying to guess the top or bottom before the sweep happens. A common mistake is selling immediately at resistance. You might be right about the direction, but wrong about the timing. Before every trade, ask yourself, where is the nearest liquidity? Has it been taken? Is there a structure shift? Remember the formula: liquidity sweep, followed by a structure shift, then a pullback to your entry. This framework works across Forex, indices like the NAS 100, and commodities. It's the key to thinking like an institution. Subscribe to The Profitable Trader for more lessons on mastering the markets. See you in the next video.